Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking a few minutes out of your holiday week to watch this stock market update and industry sector review for the week ending Friday, July 6th, 2018. Before I jump into the charts and commentary, I would like to begin with a quote from a very dear patriot of all of us, and that is George Washington, probably the most important founding father. I felt a quote from him would be perfect for the week of Independence Day. Well, we all know he was the first president of the United States, but here's a few other facts about George that you may not know. George Washington was born in 1732 and died in 1799. His family were prosperous planters among the colonial Virginia gentry. His education was basic, but included surveying, which launched his early career as a surveyor. He followed his brother Lawrence into the Virginia militia at the age of 20 and gained experience and reputation during the French and Indian War, rising to the rank of colonel. George Washington once said, "We should not look back unless it is to derive useful lessons from past errors, and for the purpose of profiting by dearly bought experience." Those are some wise words from George Washington. I'd like to add that just remember, do not forget that the trials that we face throughout our lives should be looked upon as opportunities to grow, gain knowledge and wisdom, and to open the door for possibilities that may help us toward our goals we want to achieve in life. Well, let's go ahead and talk about the stock market. It continues to be extremely volatile. The Dow Jones Industrial Average has closed down below its 200-day moving average for 7 days in a row, which it hasn't done in years. The S&P 500 and the NASDAQ are just a little behind it. They are still above their 200-day moving averages, but they are also showing signs of weakness. That has a lot to do with some of the things we are facing here at home, both politically and economically, but it also has a lot to do with things that are happening overseas. The Chinese stock market, as represented by the Shanghai Composite, is down about 20% over the last few months, and the Japanese Nikkei stock market is down about 9.3% since January's high. And the German DAX stock index is also kind of following the same trajectory as the Dow and the Nikkei. So world markets are down substantially, and in fact, in the first quarter, or I should say the first half, in the first half of 2018, world stock markets have declined in value by $10 trillion. It's a pretty significant number, considering our national debt here in America is about $21 trillion. Either number is pretty astounding, but a $10 trillion decline in global stock value that's a lot of money that doesn't exist anymore to this day. Well, let's go ahead and take a look at those charts. We'll begin with the Dow Jones Industrial Average, and I'll point out a lot of the details about those indexes as we go along. Okay, looking at this chart of the Dow Jones Industrial Average, you can see that the 5-day moving average in red is now below the 20-day moving average in blue as of June 20th. That is a short-term weakness signal or a confirmation. The 20-day moving average in blue is still above the 50-day moving average in purple, so we still have some intermediate-term strength. But really, this particular stock index has gone nowhere since its lows of about February 7th or so. So it's been going back and forth, but has not made any upward or downward progress since February 7th. Right now, the price is below the 200-day moving average in green for the last 7 days, which is very weak and very bearish. It hasn't done that for years. So be very cautious on the Dow Jones Industrial Average. We need to see some improvement in this thing to consider it at all as an investment index, but right now it is looking weak and bearish. Let's take a look at the support lines again that I've outlined in prior videos, connecting the low of March 23rd May 3rd as well, and drawing that trend line up, that is the trend line that the Dow was holding and was making a really nice uptrend, but it broke it pretty severely on June 25th, it looks like. Yes. And then broke through the 200-day moving average as well, and has tested the 200-day moving average 2 times from underneath and failed both times. So we now have the Dow below all major moving averages, the 5, 20, 50, 100, and 200-day moving averages, which are technically important for the market. This index has broken them all, and that is a sign to remain very cautious. Here's a chart of the S&P 500 stock index, and this too is in a decline that began really on June 12th. The 5-day moving average cut right through the blue 20-day moving average, so we have a short-term weakness confirmation as of June 25th. And the 5-day moving average also cut below the 50-day moving average, and that is where the price is currently, as indicated by this black line right here. So the S&P 500 is stronger than the Dow Jones Industrial Average, but they are both in a declining trend. And the S&P 500 is also above its 200-day moving average, which still is a sign of strength for the moment. The 200-day, the 20-day moving average is above the 50-day moving average in purple, so we have intermediate term strength as well, and a decent amount of it still, but mixed signals here, the short-term weakness signal and the intermediate term strength signal. So we just need to keep an eye on this and see if it continues its decline, or see if it can save itself and get that 5-day moving average back up above the 20. Right now, let's take a look at those support lines just like I did with the Dow. Let's connect the low of April 2nd and draw that line up there and connect it with the low of May 3rd. This is the rising trend that the S&P was in, and it broke that on June 27th. Tried to recover and then failed again on July 3rd. So right now, the rising trend has been broken, and we need to keep an eye on this. So be very cautious with the S&P 500 at this time. In addition to that, I will show you those resistance lines that I pointed out in prior videos. These highs up here from February 26th and March 9th and March 12th, that if I put a line right there, make it bigger, you can see that those prior highs were extreme resistance for this S&P 500. The S&P rallied up, tagged those 2 prior highs on June 12th, and then just rolled over hard to the downside. So right now, that particular point on this chart, those 3 highs, is now some significant resistance for the S&P 500, and it will take a significant economic improvement to drive this index higher at this time. Here's the NASDAQ 100 stock index, and this also topped back on June 20th and has been in decline. The 5-day moving average in red is now below the blue 20-day moving average, indicating short-term weakness. But we still have the blue 20-day moving average above the 50-day moving average in purple, indicating intermediate term strength. So we have mixed signals right now, telling us to just remain cautious. This particular index came down from its sell-off and hit that 50-day moving average on June 27th and then bounced off it into July 2nd and then sold off significantly on July 3rd. So we need to see if the NASDAQ 100 continues its decline or if it can recover itself and bring that 5-day moving average in red back up above the 20, giving us 2 strength indicators at the same time. Right now, though, that prior high from January 26th, that is the resistance that we had to get through, and we broke above it back here on June 1st, rallied up here, and then when we failed, we broke back below that prior high of January 26th, then rallied up again and then failed again. So on the 3rd of July, we are back below that high of January 26th, still indicating that this whole rally for the month of June may have been a false breakout. So be very cautious with the NASDAQ and NASDAQ 100. This chart is looking mixed and looking to be more weaker than stronger. Here's the chart of the S&P 500 Consumer Staples Stock Index, and as I've said in prior videos, this is my favorite chart right now. This one's looking really good after a 17% decline in the Staples Index from January 26th until the lows of about May 3rd. This particular index spent much of May just going sideways, and then it broke out of this declining, this is a declining bullish wedge pattern. The red line on the top connecting those three highs, this one, and this one, is the upper boundary of the wedge, and then this line here connects the lower portion of that wedge. And sure enough, about 3/4 of the length down the wedge, we broke out, and we've been rallying up since. Now we've had a little bit of a sell-off here just briefly, or just a little bit, since June 25th. But the 5-day moving average is above the 20-day moving average, indicating short-term strength. And the 20-day moving average in blue is above the purple 50-day moving average, indicating intermediate term strength as well. So right now, this thing is aligned in a strength mentality, I guess you could say, or the direction of strength, which is good, and it has been rising pretty steadily since about May 3rd. So right now the consumer staples are looking really good, and they're still about 15% or so off their highs. So right now I see a lot of blue sky here for the consumer staples chart. Here is a chart of the S&P 500 Industrial Stock Index, and this thing is the weakest of all the charts I've shown you so far. It peaked back here on June 26th and has been getting weaker by the month. We have been in decline now steeply since June 11th, and the 5-day moving average in red has crossed below the 20-day moving average, indicating short-term weakness. The 20-day moving average in blue has crossed below the 50-day moving average on June 29th, indicating intermediate term weakness. And the 50-day moving average in purple has crossed below the 200-day moving average in green, which indicates long-term weakness as well. The only thing that's saving this particular index at this time is the May 2nd low, which is providing some support. I will draw a line there for you, and you can see where we're at. Right there is the support, May 2nd. We came down and touched it on June 27th, bounced off it, and we're still hanging out right above it. But if that support line breaks, then the industrials index is headed for lower price based on what I see here. So use caution. This chart is looking very weak and very bearish. Here's a chart of the Dow Jones Financial Stock Index, and this index also is looking very weak. It has been in pretty steady decline since its high of January 26th, and the 5-day moving average and the price of the financials index are now below the 5-day moving average and below the 20, below the 50, below the 100, below the 200-day moving average, which all typically provide support for this index. And right now it's broken all of them. So right now we have short-term weakness indicator or confirmation as of June 18th, when the 5-day average crossed below the 20. And the 20-day moving average in blue is 1 day away from crossing below the purple 50-day moving average, which is going to generate a intermediate term weakness signal as well. The only thing that's supporting this particular index right now is some of these prior lows, and if I draw a line from this low right here, which is May 3rd, you can see that we came down, touched that May 3rd low right there, and bounced off of it into the high here of July 2nd, and then we dropped again on July 3rd. So right now This low here is providing some support, but if this red line breaks, then that opens the door for the financials index to go back down and test these two lows of March 23rd and February 8th. So significant caution is needed in this financials sector right now. We need to see this thing turn around and start to head higher. Otherwise, it's going to have some very bearish indicators in place. Thank you again for watching this market update. I hope you found the charts and information useful. The key takeaway for this week is to remain cautious. The Dow Jones is showing severe weakness, and the S&P 500 and the NASDAQ are not far behind. Many of the stock indexes are following along with them, but a few are not, and I pointed those out to you already, so you know what to be looking for. And the Asian, European, and emerging markets are also looking extremely weak, and several are in fact bearish. So caution with the overseas stuff as well. Before I go, please do me a favor and click the subscribe button on this YouTube channel, and then click the little bell next to it so you'll be notified whenever additional videos are posted. And in the top right hand corner of christensenwealth.com, you will find the icons and links to the Facebook, LinkedIn, and Twitter page for Christensen Wealth Management. Please visit those when you have a few minutes and like or follow those pages. You will also find those links in the summary description of this YouTube video. So using social media, I can communicate with you timely throughout the week, and then once or twice a week I can communicate with you through these videos. Well, have a great week and enjoy the rest of your Independence Day week and weekend, and look forward to seeing you again in about another 7 days. Bye-bye.